Hello, this is Greg Forstoffel, and I'm back with the second video, taking a look at the 2009 results of United Bank and Trust, United Bancorp. Um, what were their results in 2009? What do I think is going to happen in 2010? In this section, this video, we're going to talk about 2009 year-end balance sheet. Going to take a look at my forecast for 2010 income. Also going to begin the discussion of 2010 loan loss analysis. Loan loss analysis is a big issue, as everybody knows, and going to start the discussion about what my opinion is on where loan loss expense is going in 2010. So let's take a look. This is a summary of the trend in the balance sheet over the past several years. And I'm going to take a look at what the balance sheet ended up being in 2009. What we see basically is a flight to liquidity. And what that means is that the loans, the long-term assets went down at the same time that the short-term assets went up. Short-term assets would be cash and cash equivalents and near cash assets. And those went up, and they were financed largely by two factors. One is an increase in deposits. Short-term liabilities went up about $70 million at the same time that long-term loans went down by about $50 million. Now, whether they went down because of foreclosures or just people weren't creditworthy or maybe they didn't want to borrow, whatever the reason was, the loans went down by about almost $50 million. And you see basically an overall repositioning from longer term assets to shorter term assets. At the same time, looking at the capital on the balance sheet, we see that the preferred stock, $20 million, was entered on the balance sheet at the beginning of 2009. This $20 million is a preferred stock position by the U.S. Treasury, and that is the position for which the bank owes $1 million in dividend every year. At the same time, also the combination of the common stock and the retained earnings went from basically $60.5 million down to about $60 million. That's 69.5 down to about $60 million. So a loss of about $9 million in capital. So they lost about $9 million in common capital, but gained about $20 million in preferred. The preferred has some restrictions. It has the government looking over the shoulder of the bank, and at least for myself, not speaking for everybody, I just find that an uncomfortable situation. The other thing to note is that the capital ratio in 2009 went from 8.3% up to 8.9%. However, that, in general, that's a good thing, but the reason it went up that high is because of the preferred stock position. Excluding the preferred stock position, the capital ratio went from 8.3 down to 6.8, which is that's getting in the area where regulators are beginning to take notice and not liking the situation very well. Now let's take a look at 2010 briefly. What I think we can expect in 2010. 2010, I expect to see core earnings around $13 million. In quarter one, there was loan loss expense of $4.8 million. Rest of the year, what's it going to be? I'm going to take a look at that in a bit. As I mentioned, the bank is currently increasing its liquidity. Its loan portfolio is decreasing. At the same time, it's increasing its short-term investments. Per the Memorandum of Understanding, the bank needs an additional $8 million in capital. It needs that by mid-June. And that was revealed at the shareholder meeting back in early May. The Memorandum of Understanding had been in place since early January, but we just found out that meant an additional $8 million of capital infusion is required. And finally, there's no plan to repay the U.S. Treasury the TARP money, the $20.2 million that it borrowed in early 2009. Now, let's take a look at income trends and forecasts. These are the major categories in income. We got interest income, net interest income, non-interest income, and core earnings. We see that all incomes peaked in 2007, and we also see that the loan portfolio peaked about that time. So that explains why the interest income was highest during those periods, and then it's been tailing off. This year, I believe that interest income is going to be around $41 million. Net interest income is going to be about $30.8 million. Non-interest income is going to be about $12.9 million, which is a decrease of about $4 million from the year before, and that's due to the fact that there won't be as much sales and servicing of loans as there were in 2009. The banks told us that. And after all that, I think that the core earnings is going to be $13.1 million. Core earnings is all of this before loan loss expense. So loan loss expense is going to determine whether there is a net income or not. And this is just a graphical presentation of what we just saw in the income. And again, all those incomes peaked in 2007 and are tailing off since then. You see the net interest income has stayed steady, and the core earnings is starting to increase again. Let's talk just a bit about loan loss expense, and I'll continue it in the next video. Basically, loan loss expense is the single largest expense over which management has control. The expense is accrued prior to the loan actually going bad. So that basically means when the loans reach some point that the accounting rules say it has met, then they must determine how much of the loan has been impaired, and that's what they do. And they accrue the expense prior to the loan actually going bad, prior to people actually defaulting on it. The segment that's the biggest problem is called construction and land development. And last year, the construction and land development was a source of 14.4 of the almost $26 million loan loss expense. Then in 2010, quarter one, loan loss expense was $4.8 million. And the question is, what's it going to be the rest of the year? And I'll start that discussion now, but continue it on the next video. And basically what this is showing is that I've got three estimates, and I will talk about how I came up with those estimates in the next video.